Imagine a busy financial center suddenly filled with fear. In the late 1929, after a decade of rapid economic growth and booming stock market prices, Wall Street traders fell silent. Panic swept through the markets. Within just a few months, the US stock markets had lost nearly 90% of their value. Investors saw $25 billion of wealth wiped out. And when we adjust this in the inflation terms, this is about $400 billion today. So, in this video, we'll ask what triggered these disasters and most importantly, how some of the questionable decisions made it worse. Now, to truly understand what we are addressing in this video, we need to first clarify some of the important terms, which are recession, depression, and bubbles. These are often used interchangeably, but they are not the same. A recession is a temporary economic slowdown, typically defined as 2 consecutive quarters of negative GDP growth. For example, if you check the current report on the US GDP, the Q1 of 2025 saw a negative GDP growth of minus 0.5. The Q1 of the negative GDP in the USA still does not define it as a recession. However, if the data by the BEA, which is the Bureau of Economic Analysis, which will be next released on July 30th, shows another negative GDP, then we'll say that the US has hit a recession. But when we talk about a depression, it is far deeper and longer lasting, typically defined as a GDP contraction of at least 10% or an economy in contraction for 3 or more years. For context, the US has endured several recessions, but only one true depression, the Great Depression from the 1929 to the 1941. Please let me know in the comments if you know about any other Great Depression that the US has faced earlier in the history. Like, check this graph where all the shaded regions represent the recessions that the US has seen in the last 60 to 70 years. See how in these periods the graphs are inverted, showing negative growth of GDP. The impacts caused by depression and a recession are also different. The recession of 2008-9 involved a 4.3% of GDP contraction and a peak unemployment of about 10%. In contrast, the Great Depression of the 1929 at its lowest point, unemployment near 25% and GDP plunged to about 30%. Now, after a recession and a depression, let's also talk about a bubble. A bubble is different. It's when the price of the assets like real estate, stocks, bitcoins, NFTs, etc. soar far above their intrinsic value. Now, what is intrinsic value? Intrinsic value is what something is actually worth based on its fundamentals like income, earnings, or future cash flow, not just what people are willing to pay for it in the moment. For example, the stock bubble of 1929, the dot-com bubble of 2007 and 8, and the NFT and the Bitcoin bubbles that we have seen recently. Bubbles crash, but a crash doesn't automatically become a recession or a depression. Still, a bursting bubble can cause a recession and in rare cases a depression if the fallout spreads deeply through the economy. Can you let me know in the comments if we do have bubbles formed right now for some of the assets? So in summary, a recession are common economic downturns. A depression is a very long, deep recession, and bubbles are speculative spikes in prices of assets that can crash and contribute to a recession or a depression. After the World War I, the US entered into a period of dramatic expansion. But why did the economy expand after a devastating global war? The reason is like this. During the World War I, the US factories ramped up the production of weapons, uniforms, and food items, not only for the American troops, but also for allied nations in Europe. You might wonder why the US factories provided food and supplies to the allied allied nations in Europe like Britain, France, and Russia. This was because the US fought the war with the allied powers and not against them. This wartime demand supercharged the American industry, giving it a powerful head start after the World War I. Now, after the war, the American factories were running at full speed, making weapons, uniforms, and food items, right? Now, the war ended and the American soldiers returned home. So, these factories shifted from producing weapons to more civilian consumer goods like radios, appliances, and cars. But still, something more revolutionary was to happen. In 1913, Henry Ford, at his Highland Park plant, introduced the first true moving assembly line. Now, the assembly line was a new manufacturing technology which revolutionized the manufacturing industry, especially the automobile. This method involved a moving conveyor belt that carried products past the workers, each performing a specific task. This method was so efficient that it cut the car building time from over 12 hours to just 93 minutes. Now, this speed of manufacturing increased the supply of cars in the market and hence reduced the prices dramatically. In 1910, for example, a Model T cost about $825, and by 1917, it was just $350 within the reach of the middle class. But Henry Ford didn't stop there only. He doubled the workers' pay to $5 per day and cut the shift hours to 8 hours per day, launching the 5-day work week. Now, these innovations didn't just boost Ford, they triggered a manufacturing revolution. Other industries copied him: appliances, steel, glass, tools, all now using assembly line production method to meet the surging demand. So what began as a war effort transformed into a consumer explosion. Mr. Ford turned industrial power into the middle class prosperity. But there was one more piece to the economic boom that the USA was witnessing at this point of time. For the first time in the American history, the stock market wasn't just a thing of the bankers and the industrialists. It became a place for the ordinary citizens also. Teachers, store owners, taxi drivers, everyone wanted it. With the economy booming and the wages rising, Americans had that extra cash and a new belief that investing in the stock was a way to build up wealth fast. By the mid-1920s, around 1926-27, stock tips were being given out in barbershops and dinner parties. But this stock market frenzy reached to that level where people didn't stop investing their savings into stocks. It escalated into something far riskier, which is borrowing money to buy the stocks, a practice which is called margin buying. With as little as 10% down, everyday Americans could control large stock positions. For example, by just putting $100, one could buy $1,000 worth of stocks, the rest borrowed from the brokers. Now, margin buying created a fragile tower of debt, all built on the belief that stock markets would never crash. Some economists warned of the danger, but most Americans, even many experts, believed that the party would go on forever. Then came the doomsday. It was October 24, 1929, a Thursday. Most Americans woke up to what seemed like just another day. But on Wall Street, fear was already spreading like wildfire. Stock markets had been shaky for quite a few weeks, but that morning it hit with a full force. But why did the stock prices started falling at the first place? Because by the late 1929, stock prices were no longer grounded in reality. Many companies' stocks were trading at 2 times, 3 times, even 10 times more than what their earnings justified. Profits were not growing fast enough to keep up with the soaring prices of the stocks. Corporate fundamentals had been ignored. Everyone was buying, not because businesses were doing good, but because they thought the next buyer would pay more to buy the same stock. The FOMO factor, Now, smart investors sensed that the market was going too speculative. Hence, these investors quietly started selling in September of 1929. Then came a few bad earning reports and the confidence cracked further. So on Monday, October 28th of 1929, the Dow Jones plunged nearly 13% in a single day. The next day, October 29, now called the Black Tuesday, it fell again. Over 16 million of shares were dumped and fortunes evaporated in hours. By mid-November, the Dow had lost almost half of its value. The slide continued through the summer of 1932 when the Dow closed at 42, its lowest value of the 20th century, 89% below its peak. Some people lost everything, and because many had bought the stocks on debt, they didn't just lose their savings, they were left deep into debts. Brokers demanded repayment, but now with the stocks being worthless, people had nothing to give. The damage quickly spread. Panic gripped the nation, small banks began to collapse. They also had invested into stocks or lent to customers who now couldn't repay. Within months, thousands of banks failed and millions of Americans lost control and access to their money. What began as a market crash had become a full-blown economic collapse. Jobs vanished, factories went void, entire families were thrown into poverty. Now let's see how the US government responded to the economic situation. So when the stock markets crashed in October of 1929, many Americans looked to the government for their rescue. But mostly what followed was not a bold rescue, it was confusion, hesitation, and in some cases, decisions that made the crisis even deeper. So the first mistake, or I can say the misjudgment, came from the Federal Reserve. In 1928, well before the crash, the Federal Reserve had gone worried. As you now know, the stock prices were soaring high above their intrinsic values and speculation had reached dangerous levels. People were borrowing recklessly to invest into stocks. So, in an attempt to cool the bubble, the Federal Reserve raised the interest rates sharply. You might know that the central banks, like the Federal Reserve, normally increase the interest rates to discourage the lending or the borrowing. Similarly, here in 1928 and 29, the Federal Reserve's thinking was simple. If borrowing became more expensive with high interest loans, fewer people will gamble on the stocks. But here the critical mistake that the economists point today. After the crash in October of 1929, the Federal Reserve did not quickly reverse the course of action. Instead, it hesitated. It kept the interest rates relatively high well into 1930, afraid that cutting the interest rates might reignite the speculation. However, this decision had devastating consequences. Higher interest rates meant that banks had less money to lend. Businesses struggled to get loans to function properly, and with less money circulating in the economy, demand collapsed even further. Let's now talk about the second big misjudgment made by the government. So in 1930, the Congress passed one of the most infamous laws in the US economic history, which is the Smoot-Hawley Tariff Act. The goal of the act was to protect the American farmers and industries by raising tariffs on imported goods. Do you see something similar happening these days? Let me know in the comments. So alright, coming back to the video, the result of the act was a global trade war. So countries like Canada, Britain and Germany retaliated by tariffs of their own. Consequently, the world trade collapsed by over 60% between 1930 and 1933. The US president at that point of time, Mr. Herbert Hoover, believed that the economy would self-correct. He resisted large-scale government funding and relief programs. A self-made millionaire, Mr. Hoover believed in rugged individualism, meaning the idea that Americans should overcome hardship through hard work, self-reliance, and the strength of their communities. He believed on the idea that it was not the federal government's job to provide direct aid to people, but the local charities, churches, and neighbors should take care of each other. He urged the businesses to keep the wages stable and states to take the lead. But as unemployment soared, this hands-off approach of Mr. Hoover only deepened the problem. By 1932, 1 in 4 Americans was unemployed. Result did not come until Franklin D. Roosevelt took office in 1933. Through a sweeping set of programs known as the New Deal, the government began creating jobs, building infrastructure, and reforming banking and labor laws.
Justice, my friends, this is a day of national consecration. And I am certain that on this day, my fellow Americans expect that on my induction into the presidency, I will address them with a candor and a...
This was the time when reforms like the Public Works Administration Act and Works Progress Administration were introduced. Eventually, the US emerged out of the Great Depression in 1941-42. Now, some credit the New Deal with stopping the free fall of the US economy. Others argue that World War II ended the Depression. But one thing is clear, that bold action replaced silence. So were the 1930s policies good or bad? What do you think? And now, over a century later, we are once again asking ourselves, could it happen again? Are today's debt levels, asset bubbles, questionable government decisions, and geopolitical risks pushing us towards another breakdown? If you learned something, please subscribe. Thanks.